Hi everyone, this is Ali Hussein Kasim of Ali Talks Tech. In this week's roundup, we cover around 4 stories. The first one is about Flutterwave and its recent receipt of an imprimatur from the Bank of Ghana, the financial services regulator in Ghana, where it received a payment service license. We will also then cover Mansa Finance and its liquidity pool for fintechs across Africa. We will then look at how Nigeria is becoming the most gung-ho country when it comes to implementation of regulations against big tech. We'll then cross over to England and look at how the Bank of England is approaching innovation in money and payments. So, to Flutterwave first. Flutterwave is an interesting story for me, simply because it is potentially the largest fintech in Africa. That title is probably in contention because, Cellulant is there, although much older, with licenses in 18 African countries. But Flutterwave has really sort of stood out for good reasons and bad reasons. Humongous growth, telling a good story of African fintech, but then also in the last couple of years has really suffered in terms of compliance and regulatory issues as far as some jurisdictions are concerned. And in this conversation, I'm specifically pointing on to Kenya. Kenya has just refused to give Flutterwave a license, payment service license. Now, recently, just last week, Flutterwave has received an enhanced payment service provider license by the Bank of Ghana. And I have it in good state that a license in Uganda is just about to be announced. So, as a leading fintech in Africa, and Kenya as one of the most important fintech markets in Africa, this is something that Flutterwave is obviously very concerned about, not having a license in Kenya. So, last year, I think, and early this year, the last cases against Flutterwave in Kenya, potentially accused of money laundering and all sorts of other financial misdeeds, all those cases were thrown out. Yet, the Central Bank of Kenya still is silent on giving Flutterwave a license. Now, I'm not going to second guess the regulator, but I think this is an issue of public interest now. I think the central bank simply needs to come out publicly. This is not a state secret, and tell everybody in the fintech ecosystem and in financial services and in general why Flutterwave has not received a license to date. Flutterwave has licenses, various fintech licenses across countries globally. The United States, the United Kingdom, Nigeria, of course, the home market, Tanzania, Rwanda, South Africa, Egypt, the EU through Cyprus, Canada, Cameroon, Mozambique, and Malawi. And now Ghana and Uganda. So, one of the key issues that the Africa Fintech Network, which is a pan-African umbrella group of national fintechs across Africa, around 43 of them, one of the issues we are addressing, and as I say we because I sit on the board of the Africa Fintech Network, is that policymakers and regulators across Africa must deal with this question of fintech licenses or passporting and harmonizing of fintech policy and regulatory frameworks across Africa so that it doesn't seem unseemly that some countries, some fintechs find it easier to get licenses, and in some countries it becomes an issue. I'm sure by now regulators are sharing information. So the billion-dollar question literally is, has the Central Bank of Kenya consulted with the Central Bank of Nigeria, the Central Bank of Ghana, the Central Bank of Mozambique, Malawi, South Africa, and asked, what have we missed? I know these are uncomfortable questions, but these questions must be asked. It is my hope and prayer that this issue of Flutterwave receiving or not receiving a PSP license in Kenya will be put to bed as soon as possible. We move to an interesting story that is struggling fiat currencies and crypto. Mansa, Fintech based in the UK, has just launched its first liquidity pool on Base, which is a secure and low-cost Ethereum equivalent level 2 blockchain built on the OP stack by Coinbase. This move aims to enhance financial services for multinational exports and cross-border payments, particularly benefiting businesses in emerging markets. The key highlights of this would be to enhance financial accessibility. Mansa's new liquidity pool focuses on remittance and stablecoin liquidity provision, enabling African businesses to access cheaper capital and overcome traditional financial barriers. The other key aspect of this will be innovative collateral options. The platform will allow venture-backed businesses to utilize a diverse range of assets as collateral, significantly broadening the pool of potential borrowers and fostering greater financial inclusion. It will also address credit gaps. A substantial financial gap hinders growth in emerging markets, and Mansa's approach offers potentially timely solutions that leverage decentralized finance, DeFi, to facilitate economic expansion. Some insights here. The CEO, Molunku Sanu, expressed enthusiasm about this launch of the liquidity pool, stating that it will help businesses navigate USD limitations and manual processes that have historically constrained their growth. Building next-generation financial infrastructure. By connecting African businesses with global investors, Mansa is creating a transparent and accessible platform that addresses the lack of financial services and foreign exchange constraints prevalent in the African region. As Mansa continues to innovate and expand its offerings, this launch will mark a pivotal step towards reshaping the financial landscape for businesses in Africa and beyond. We now move to Nigeria's regulators wrestling with big tech. The latest bout is against WhatsApp. I mentioned this a week earlier, but WhatsApp is now threatening to exit the Nigerian market. So this is typical of Meta and Facebook. When they are against the wall, they threaten to exit a market. They did this last year in Australia, when Australia had a big tiff around how Facebook is using media content without compensating media companies. How is this going to pan out? In a bold move, the Federal Competition and Consumer Protection Commission of Nigeria has stood firm against WhatsApp's threat to withdraw its services from the country. This comes in response to a recent $220 million penalty imposed on Meta. Meta is the parent company of WhatsApp and Facebook. WhatsApp's parent company for alleged data privacy violations. So the FCCPC dismisses WhatsApp's claims. The commission has simply said that WhatsApp's assertion that the penalty order will make it impossible to provide the service in Nigeria or globally. The FCCPC maintains that WhatsApp's statement is aimed at influencing public opinion, playing to the public podium, and pressuring the regulator to reconsider its decision. The regulatory stance the FCC emphasizes is that its actions are driven by legitimate consumer protection and data privacy concerns. The Commission underscores that its final order requires Meta to comply with Nigerian consumer standards and meet local regulations, similar to measures taken in other jurisdictions, especially in the European Union, without forcing companies to leave the market. Nigeria has shown resilience in this. A couple of months ago, they slapped a $4.5 billion fine on Binance, the leading crypto exchange in the world. That case is still ongoing. With over 51 million WhatsApp users as of February 2024, Nigeria remains steadfast in its commitment to protecting consumer rights and data privacy. The country's stance sends a strong message that it will not compromise on these critical issues, even in the face of threats from global tech giants. Let's have a quick look at Meta's regulatory issues at a global level. Meta, Facebook's holding company, is facing regulatory issues in at least a dozen nations, and large penalties are being appealed across the continent. The company has recently settled at a whopping $1.4 billion in a Texas case, which underscores the increasing scrutiny it faces worldwide. Who's going to blink? Babatunde Irukure, the former chairman of the SCCPC, aptly noted on X that Meta's threats to exit markets are not unique to Nigeria, emphasizing the company's global regulatory challenges. So as Nigeria continues to navigate the complexities of regulating the digital landscape, this standoff with WhatsApp highlights the country's commitment to protecting its citizens' interests while fostering a thriving tech ecosystem. This outcome will undoubtedly have far-reaching implications for the future of data privacy and consumer protection in one of Africa's largest economies. Lastly, I want to look at the Bank of England's approach to innovation in money and payments. And I've specifically picked this up, although it's not in Africa, because Europe and especially the UK has become a thriving place for fintechs, mostly because of the collaboration between private sector and government in ensuring there is an enabling fintech regulatory and policy frameworks. This is crucial for the growth of the financial services sector, which is increasingly becoming fintech driven. So the Bank of England has recently published a pivotal discussion paper outlining its approach to innovation and payments. The paper emphasizes the need to adapt to a rapidly changing financial landscape. As the world becomes increasingly digital, the bank recognizes that innovations in payment systems present both opportunities and risks that must be carefully managed. Here are the key insights on this discussion paper. Trust as the foundation. At the core of money is trust, which is essential for maintaining confidence in the financial system. The bank is committed to preserving this trust while navigating the complexities introduced by new technologies. Engagement with innovations. The bank's approach is proactive, focusing on understanding and preparing for innovations such as programmable platforms and distributed ledger technologies or blockchain. These technologies have the potential to enhance efficiency and reduce costs in financial transactions. Balancing risks and opportunities. While innovation can drive progress, they also pose risks to monetary and financial stability. The bank aims to create a regulatory environment that supports safe innovation while safeguarding the integrity of the financial system. Future of payments. The discussion paper also highlights the need for a comprehensive strategy that encompasses both retail and wholesale payments. The bank is also exploring the potential of a retail central bank digital currency, or CBDC, to ensure that the central bank money remains relevant in an increasingly digital economy. Collaboration and feedback. The bank invites stakeholders to provide feedback on its proposed approach, fostering a collaborative environment to shape the future of payments in the UK. This open dialogue is crucial for developing policies that reflect the needs of the market. As we move forward in this digital age, the Bank of England's commitment to innovation and stability will play a vital role in shaping a resilient financial landscape in the UK and beyond. All I can say is interesting times ahead, guys, for the future of money and payments. We come to the end of our weekly roundup this week. Looking forward to seeing you again next week. Thank you, guys.